Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's Thursday afternoon, April 9th, 2015, and the title of today's audio blog is Lift Off. Now, before I get to yet another lengthy discussion of the bane of my existence, i.e. de-propagandizing the drivel spewed by the Federal Reserve and its minions, and the utterly mind-boggling idiocy of mainstream interpretations of such, I have a few other topics to address, starting with an article that not only signifies all that's wrong with the dying global economy, but portends what could be extremely dangerous political and social times in the crumbling European Union, which is the fact that the obscene 46-foot statue of the euro symbol, sitting right in the middle of the Eurozone's financial capital Frankfurt, is in such a state of disrepair it will likely be taken down. Likened to the biblical golden calf, the statue has been horribly neglected and obscenely vandalized. With each passing day, it is further mocked by both Germans and tourists alike, as clearly this ill-fated experiment is nearing the end of its rope. It's only a matter of time before the myriad nations oppressed by its German-led overlords jump ship, likely starting with the Greeks, and frankly, it wouldn't surprise me one bit if the Germans themselves wind up abandoning at some point. After all, as the financially strongest nation in the Union, albeit far more exposed to its failure than most understand, it is being pulled down by the rest, particularly the pigs, and thus, at some point, they need to cut their losses. And not necessarily by government decree, mind you, but because the people, as in Greece and shortly in Spain, France, and Italy, demand it. And secede these nations will, in the worst case en masse, but more likely one at a time, until a critical mass of inevitability causes the euro currency to either be methodically dismantled or otherwise torn apart. To that end, it is quite clear the Greek crisis will come to a head shortly, certainly before the 4-month bailout extension granted in February terminates. To wit, all the hype and excitement about Greece stealing enough from its public pension funds to meet today's measly €450 million interest payment, to the very IMF overlords calling for increased austerity. You know, the very thing the Greek people voted Syriza into power for to end, which now Prime Minister Alexis Tsipras has passionately, vehemently railed against. Yes, €450 million, which until yesterday it was highly in doubt they'd come up with, which, as I discussed yesterday, roughly equals the amount of money the Fed printed every 6 hours during its 22-month QE3 program between December 2012 and October 2014. Or better yet, the amount Chinese-controlled banks loaned into existence every 3 hours since the 2008 financial crisis 7 years ago. This is why the biggest credit, real estate, construction, and commodity bubble in history inflated in China so rapidly, which as we speak is rapidly deflating, although you'd never know it by the equity bubble that has replaced it, in many ways putting the Western equity bubbles to shame. In both cases, PE ratios, based on increasingly suspect earnings quality, have inflated to record high levels amidst the worst economic environment of our lifetimes. However, unlike in America, for instance, where retail participation is near record lows, as are the ratings of its top financial media outlet CNBC, in China, last summer's initiation of aggressive PBOC monetary easing has prompted the speculation-mad populace to open record amounts of margin accounts, to the point that the chart depicting such activity is visibly indiscernible than the most egregious internet stock bubbles of the 1990s. Or for that matter, the charts of many staid, boring companies today, like for instance, nondescript fast food restaurant chains like Popeye's Chicken, Chipotle Burritos, and Buffalo Wild Wings. I mean, these are the polar opposite of the kind of stocks that should trade like technology stocks. However, care of the increasingly transparent Yellen put, or should I say, the Yellen call, stocks of all types are trading at all-time high multiples, as the Fed makes it crystal clear that their top priority is not the economy, employment, or inflation, which obviously they have no way of improving, but the stock market. It's gotten so bad that an historical cash burner like Tesla, kept alive solely due to taxpayer-funded subsidies and rendered obsolete in a low-energy price environment, rockets higher when its obscenely promotional CEO, Elon Musk, tweets of his optimism. Rarely, if ever, do I predict anything about market movements anymore, and given my role not as a financial advisor but a mere truth-teller, I'm not about to start now. However, in last week's stock crash to end all stock crashes, I clearly stated for the first time that Western equity markets were amidst an historic bubble, which either via hyperinflation Venezuela style or crash 2008 style would inevitably yield historic real losses. I mean, heck, even New York Fed President Bill Dudley, formerly the chief economist at Goldman Sachs, just one day after I penned Fed Transparency Revealed from Mr. Goldman Sachs himself, said in a speech how we react after liftoff, i.e., the mythical rate increase the Fed has discussed for 2 years, will depend on how the market reacts. In other words, the man in charge of the Fed's New York trading desk, where more market manipulation occurs than in all other nations combined, takes his cue from how markets react, the very same ones he is charged with manipulating. Which is exactly what makes the concept of said liftoff so terrifying, as aside from being 2015's most manipulative propaganda buzzword, following recovery in 2013 and tapering in 2014, it all but mocks that those that fail to realize a measly quarter-point rate hike following 7 years of the zero bound would not only have zero positive impact, but in and of itself could single-handedly pop the aforementioned equity bubbles from New York to London, Frankfurt, Johannesburg, Mumbai, Tokyo, Hong Kong, and Shanghai at one fell swoop. Yes, the global economy is that fragile, the markets that overvalued, and worldwide debt burdens that strangling. I'll get back to Bill Dudley, Whirlybird Janet, and company shortly, but first I wanted to update you on the expanding European meltdown. Whilst QE and PPT supported equity markets whistle past the graveyard, trading at record levels amidst political, economic, and social upheaval not far gone from the prevailing environments during the Great Depression and Great Wars, albeit, unlike said eras, with not a gold standard but a collapsing fiat currency regime. Yes, as Greece proudly deposited the 450 million euros it lied, cheated, and stole from its own people to get into the coffers of the IMF, which hopes to lend it right back at increasingly usurious rates whilst demanding heightened austerity, its financial leaders, that's Greece's financial leaders, noted how next week's 2.4 billion of scheduled payments will be much more difficult, and next month's increasingly large amounts, in the words of a senior Greek official, another matter. And forget about this summer when atop the unrelenting interest payments, a whopping 9 billion of euro principal is due, for the most part, of bailout loans to the Eurogroup itself. Which is why it's so comical that the Eurogroup granted yet another 6-day extension for the Greeks to update their pitiful, ambiguous reform proposals. The ones covertly drafted by the Eurogroup itself, before yet another so-called drop-dead negotiation on April 24th. And ominous that Greece just yesterday, the head of Greece's parliament and staunch Syriza supporter, Zoe Konstantopoulou, launched a movement to categorize Greece's bailout loans as what international law deems odious debt, and subsequently to write it off as illegally incurred. Specifically, odious debt is defined as national debt incurred for purposes that do not serve the best interests of the nation, and consequently should not be enforceable. Recall, more than half of Greece's 400 plus billion euros of debt is bailout related, and thus, if it attempts to unilaterally write it off, it could set off a chain reaction of similar actions throughout Europe. And no, this is not a publicity stunt, as not only have the videos circulated on the topic gone viral, but the Greek parliament yesterday passed a motion to establish an auditing committee specifically tasked with identifying the extent of so-called odious debt. And this, whilst the European economy continues to collapse, as exemplified by yesterday's unexpected 1.3% plunge in German factory orders and today's equally ugly decline in German industrial production versus expectations of a strong increase. And better yet, completely contradicting last month's pathetic Europe is recovering comments by Mario Draghi, where have we heard that before? Last month's initially reported 0.9% increase in German industrial production was revised downward to zero. Throw in today's complete shutdown of the French airline industry, no doubt the result of socialism gone wild, and the makings of unending recession couldn't be more obvious, despite the so-called benefit of the world's second largest currency imploding like that of a third world countries. Which again screams the point of how plunging currencies help no one but the 1% directly receiving it at the expense of everyone else, in turn yielding the explosion of anti-establishment political movements from Scotland to Catalonia, Greece, Spain, France, Italy, and even Switzerland. And the scariest part of all is that the very people benefiting from such policies are those administering them, such as the aforementioned patently evil agency the IMF has become, whose head, Christine Lagarde, this very morning claimed emerging market growth prospects are weakening, and simultaneously that dramatic currency swings can be destabilizing for some countries, whilst espousing that continued monetary accommodation is needed, especially in the Eurozone and Japan. Amazing how she can state these things simultaneously without realizing that the very monetary accommodation she speaks of is the reason said dramatic currency swings are occurring, causing weak economic growth and a lack of the ambiguous structural reforms the IMF claims to be necessary for political, economic, and social stability. To that end, nowhere is the aforementioned wealth disparity more obvious than in America, although admittedly Europe's oligarchs are clearly giving ours a run for their money. To wit, the recent echo housing bubble, which sadly has been slowly deflating for nearly 2 years, solely due to Federal Reserve rate repression, vulture investing, and financial market support, both overt and covert. Yesterday, whilst at the gym, CNBC presented the results of a survey regarding the reasons America's increasing army of renters won't buy homes, which in a normal capitalistic world would be more affordable given the collapse in consumer spending atop historically high debt levels. 53% of responders claimed their finances or credit preclude their ability to buy, while 27% said they struggle to simply pay the rent, and another 20% simply choose to rent. In other words, despite the so-called economic recovery and plunging unemployment, Americans are in an historically weak financial position, which is probably why more than half receive government entitlements and why the rates of family formation, business formation, and home ownership are at multi-decade lows. Larry Summers, of all people, claims the Fed's policy of fixing interest rates is not a form of price control. But tell that to the hundreds of millions of individuals and institutions that count on interest income for their survival, let alone their ability to purchase a home. And in the case of insurance companies, as I discussed yesterday, their inability to collect interest income is a significant reason why premiums for everything from homeowners to auto, health, and life insurance continue to rise, as said institutions recoup the loss of such interest income with higher premiums. In other words, the type of inflation that destroys American households but somehow doesn't find its way into the government-rigged consumer price index. You know, the gauge the Fed uses to determine if inflation is high enough to warrant the interest rate increases. Of course, with America and the entire world for that matter, amidst an historic exponentially increasing debt bubble, even the slightest rate increase would pop it once and for all. Hence, the Fed's constant delay of such actions, not to mention the perceptual necessity of maintaining strong stock and bond markets and weak precious metals. Well, at least Summers was smart enough to realize Americans were no longer spending but saving due to the aforementioned historic debt burdens. Of course, his solution to the situation is to maintain zero interest rates, thus preventing them from ever converting their meager savings into the type of nest eggs necessary to yield increased spending and investment. You know, the type of things that revive economic activity and prevent housing bubbles from bursting. Which brings me to today's topic of a word that once inspired me with visions of Neil Armstrong, John Glenn, and the once great entrepreneurial agency NASA, which sadly has been since morphed into a pathetic, taxpayer-sucking entitlement. Only today, when I hear lift off, my reaction is no different than Alex's gag reflex in the great 1971 film, A Clockwork Orange. Yes, lift off, the unchallenged 2015 propaganda word of the year, which economically speaking can only be reasonably likened to the unrelenting explosion of shale oil production in the most heavily oversupplied market of all time, which, by the way, will only become more so as taxpayer-funded subsidies kick in this summer, incentivizing already insolvent shale producers to ramp up production in a desperate attempt to generate cash. And this, as our ill-timed extortion agreement with Iran paves the way for a 1 million barrel a day global oil glut to increase in time to 2.5 million barrels per day or more. This week's all-time high storage injection puts the exclamation point on just how dire the outlook is for the most heavily junk bond finance industry in America, which not only has been the nation's only industrial growth engine since the 2008 crisis, but the only industry to create high-paying, benefit-accruing jobs. And thus, with the BLS yet to acknowledge the tens, if not hundreds of thousands of jobs lost in this sector, which accounts for a whopping 1/3 of all S&P 500 capital spending, and the Fed's own GDP tracking model down to zero for the first quarter, I can only imagine what so-called recovery will look like in the coming months. You know, when the Fed is supposedly considering the rate increases they couldn't pull the trigger on when GDP was supposedly growing closer to 5% late last year. Which, by the way, was a complete and utter fabrication, which is probably why, among countless other factors, such as the exploding dollar, that the Fed not only did not raise rates, but has gotten progressively more dovish, culminating with Whirlybird Janet's dissemination of, in the name of my audio blog at the time, the most unequivocally dovish FOMC statement in memory at her February 24th Humphrey Hawkins congressional testimony. And that before the economic data really started to plunge. Which brings me yet again to the least favorite part of my job, i.e., maintaining tabs on the Fed's woefully pathetic policy statements and separating the reality of their QE to infinity mandate and the moronic interpretation of the endless line of those incentivized to spin it for their purposes. Of which I can only say that yesterday's FOMC minutes shenanigans were aptly scheduled, right before Saturday's 2-year anniversary of the infamous closed-door meeting between Obama and the too-big-to-fail bank CEOs to discuss the, quote, stability of the financial system. That same day, Goldman Sachs, whose CEO, Godsworth Blankfein, was in attendance, issued an aggressive short sale recommendation on gold. And lo and behold, what I've since seemed the alternative currency's destruction raids commenced the very next morning, taking gold and silver down by $250 an ounce and $5 an ounce respectively during a 48-hour trading span in which not a shred of incremental news was disseminated. Since then, the blatancy of the cartel's suppressive efforts, not to mention the PPT's maniacal equity support, has coincided with the broadest economic collapse of our lifetimes and equally destructive commodity and currency volatility. Is it any coincidence that said meeting occurred simultaneous with the commencement of Japan's Abenomics, the Fed's QE3, and heightened rhetoric of the ECB's own inevitable whatever-it-takes QE scheme? At or around that fateful meeting, the propaganda buzzword of recovery was spread to all utilizable Washington, Wall Street, and MSM media outlets at Ebola-like speed, followed shortly by tapering, which per my December 2013 article, Proof of the Tapering Mirage, the Fed did the opposite of behind closed doors. Remember the mystery Belgian Treasury bond buyer, anyone? The goal of this scheme, whether directly concocted at said meeting or as an obvious extension of it, was to convince the world that QE had in fact succeeded in generating a sustainable recovery, particularly in the all-important labor market that constituted part of the Fed's dual mandate, thus enabling the Fed to eventually raise rates and unwind its $4.5 trillion balance sheet. At this point, the extent of U.S. economic data manipulation went off the charts, particularly regarding employment data, but other island of lies reports like the ambiguous, statistically insignificant diffusion indices and confidence surveys we are now bombarded with daily. In the former case, provided principally by a newly IPO'd private company, Market, whose incentive to directly and/or indirectly influence results to make them appear more positive than underlying economic data suggest is overwhelming. Frankly, not a heck of a lot different than that of the fictional omni-consumer products of RoboCop fame. Moreover, market manipulation built upon its initial alternative currencies destruction operative went parabolic, particularly in stocks and precious metals, but frankly in any and all markets necessary, such as the recent creation of the blatant oil PPT. To wit, on any given day, the Fed might be covertly buying treasuries to calm inflation fears or selling them to assuage deflation expectations. And of course, the Dow Jones propaganda average was officially deemed unable to ever decline, or precious metals to rise. Not that such suicidal acts won't eventually be overwhelmed by economic Mother Nature and her minions, particularly when the unforeseen consequences of such actions, like creating massive home price unaffordability and homeowner insurance price inflation, kick in. However, for the past 2 years, the level of economic and market central planning has surpassed the cumulative sum of the prior 13 years of post-economic peak manipulations, to the delight of the 1% with big stock and treasury bond positions, and the chagrin of Main Street and, of course, the army of truth seekers holding precious metals. Fortunately, said ramifications, as discussed above, are consuming the world in unprecedented fashion, while its financial assets trade at unprecedentedly high valuations, and real assets like gold and silver had historic lows. So much so, the mining industry is on the verge of all-out collapse. Fast forward to October 2014, when a combination of ridiculously rigged GDP data, like 5% growth, principally due to Obamacare-related medical spending, and historically goose stock markets enabled the Fed to get away with claiming to end QE3, at least overtly. Since then, coincidentally or not, the ongoing global economic malaise has expanded to full-blown depression, as exemplified by the all-time low Baltic Dry Index, the historic crude oil collapse, dramatic currency implosions, and even the collapse of U.S. 2015 GDP expectations and U.S. corporate earnings, which are now expected to decline for the year. Ironically, in large part, to the associated dollar surge, which no less than the White House itself recently warned of. That is, 3 months after I did so on the Miles Franklin blog. Consequently, an incredible 24 global central banks have lowered interest rates since year-end alone, with several taking rates negative and several initiating new QE programs, such as the ECB's historic 60 billion euro per month hyperinflation scheme. And this, whilst such currencies were already falling, not only exacerbating such declines, but demonstrating just how obvious it is that history's largest fiat Ponzi scheme has reached its devastating terminal phase. Since then, the Fed has desperately attempted to ignore the reality around it, in issuing FOMC statements that, whilst being careful not to suggest imminent rate hikes, have essentially paid no heed to the economic carnage around it. Back in December, it called the oil price decline and other factors transitory, and Whirlybird Janet, when pressed at a conference call, actually called the oil price plunge a net positive for the economy, even though, as noted above, it is the largest jobs and tax revenue producer, financed largely by $500 billion of junk bonds and leveraged loans whose default would spread financial carnage across the economy like the Ebola virus. However, since then, the economic data has worsened, particularly retail spending, which decidedly did not treat lower gasoline prices as a tax cut, to the point that Yellen recently hinted that the oil price plunge is indeed a negative, let alone as its associated global impact has caused the aforementioned dollar surge, which has only made the U.S. manufacturing and corporate earnings outlook that much weaker. This is why the recent statements, whilst carefully removing meaningless phrases like considerable time and patience to assuage Washington, Wall Street, and MSM recovery propagandists, have become progressively more dovish, culminating with the aforementioned most unequivocally dovish FOMC statement in memory on February 24th and validated by the contents of the March 18th FOMC statement, both of which, I might add, catalyzed sharp gold surges, despite the aforementioned relentless cartel suppression. In fact, in my February 19th audio blog, The Fed Lied and Everybody Knows It, I discussed how the minutes of the prior meeting were clearly doctored to appear more dovish than they were at the associated meeting, as irrefutably there were glaring inconsistencies between what they initially said and supposedly said in the minutes of the same meeting. This has been a premise of mine for years and has never been more appropriate. Yesterday, the minutes of the March 18th meeting were released, and as usual, their publication was the same key attack event for precious metals as usual. In this case, there was no reason to doctor the minutes, given the initial statement was already uber dovish, and since then the economic data has considerably worsened. Still, with precious metals having risen smartly upon last week's horrific unemployment report, which amazingly is already being chalked up to harsh weather, when not only was the weather no harsher than ever, but should be seasonally adjusted irrespective. But the powers that be were clearly on a mission to smash gold and silver. And as I write midday Thursday, roughly 24 hours later, gold is down 1%, silver 4%, while no other market, stock, bond, or commodity, has materially moved. Ominously, the dollar has surged this morning, after most of the precious metal damage was done, mind you, and frankly, I suspect the heightened odds of a Grexit crisis are at the heart of it. I guess we'll see, but one thing I'm sure of is that not a shred of incremental data emanated from the Fed minutes, and that the odds of a Fed rate hike this year are lower than at any time since QE3 supposedly ended in October, amidst the worst economic conditions of our lifetime and a surging dollar that the Fed must rein in, lest America will lose the final currency war, and with it any lingering hope, of which there's very little, of ever recovering the millions of high-paying jobs it has lost over the past 2 decades. Not to mention, as next year is an election year, and if Janet Yellen has any hope of being reappointed, she had better help Hillary Clinton get elected with historically easy monetary policy. Well, I guess that's enough for now, as if I say any more today, my head will likely explode. However, with each passing day and each Miles Franklin blog entry, I hope you are further realizing that we are amidst the final stage of history's ugliest, most destructive monetary experiment. The world's political, economic, and social fibers are badly fraying, and it won't take much for an event or events to tear it completely apart. In so doing, enabling economic Mother Nature and her increasingly angry minions to storm the monetary barbarian's gates. Which is why it's never been a better time to protect at least a part of your hard-earned savings with the only real money the world has ever known, i.e. physical gold and silver. To that end, if you decide to take action by buying or storing precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.